Is the stock market crashing for the year 2021? With the performance in March, it is not going anywhere. So in this video, I'm going to share with you information that you cannot find on the internet, information that I found, and also I'll be sharing with you my views of what we should be doing. See you soon. Hello, welcome back to Family Investment. My name is Alex Ko. The market looks really sad, really terrible for the month of March. It's almost the end of March and it looks like we're not far from what happened last year. It's just going on the downward spiral because we're not going anywhere. But the thing that's coming up everybody's head is the stock market crashing? Should we be worried? What data are we basing on? Really, the data's out there that's generally showing that we are not far from the dot-com bubble, financial, and the 1929 crash, which I will share with you why people are actually shouting out that there's going to be a crash coming. It's genuine. Okay, let me show you this chart, okay? Robert Shiller's 10-year simple moving average. Basically, this is a chart of the P ratio. So as you can, this chart is really interesting. Once you look at it, it just pops out your eye. Depression, 1929, dot-com financial global crash. The current CAPE level is 25x, okay? So if your P levels goes beyond 25x, it shows that that's the alarm radar. So where we are at in this chart is actually an old chart, shows 25. In fact, where we are at 32. We have actually surpassed that chart already. So does this chart actually scares you? I mean, looking at it, it is quite scary. But in fact, I found a tweet in Twitter back in 2019 and somebody already shouting out because in 2019, 14, 15, the chart actually hit 25 already. So close to where we are going to hit the current cap level. So it looks like we've already hit that level for quite a number of years. But now because of the resurgence of COVID-19, pushing lots of tech stocks up, we're actually going even higher. So we're paying for a lot of future forward PE ratio, price to earning. We're paying lots of future earnings. And this is causing this real thing called the bubble. Do I believe the market crash can? I mean, it is a scaring chart. I'm actually looking at the chart, I'm actually scared. But I found a different chart here as well. So this chart is basically the PE ratio earning, the similar one, PE ratio earning against the long-term interest rates, okay? So long-term interest rate have been dropping since 1981 in America. It's just been dropping, and now you've seen that PE ratio earning going up. So where I'm coming from is with low interest rate climate, companies can actually borrow more money. They borrow more money and they can produce results. In the dot-com bubble crash at that time, is a lot of companies were borrowing huge amount of money and they were not producing results. And they were just basically burning money away, creating companies into a bubble which they were trying to produce and come out, but only the likes of Amazon and Google all stood up, but a lot of other 20s and 30s big mega cap billion companies were all folded away. But I don't see it this way because with the future earning forecast for 2021, 22, lots of growth stocks, lots of tech stocks, lots of mega cap stocks are keeping their promise. They're actually beating earnings, actually keeping their promise and revenue growth, and they're changing. So I think the PE ratio, hopefully, if they go sideways, not go up the way, if they go sideways and start making their promises, those PE ratios will start falling down. So if you see the likes of Adobe, Amazon, Google, Facebook all going sideways, it's a good thing. I'll be even more worried if I've seen Apple at 200. I'll be even more worried if Tesla is sitting at 1,500 now. I'll be more worried if Amazon is sitting at if Amazon is sitting at $4,000 now. I'll be more worried if these stocks are going up. It's good they're going sideways. It might even go sideways for 2021. So if they go sideways for 2021 and their earnings start beating Q1, Q2, Q3, God, you'll be holding a great company at a great undervalue after that. So for me, a market crash, potentially, but I don't think it'll be an overall market crash. And my second point about the market crash as well is it's different in 1929 and it's different in 2000. In 1929, when there was a market crash, all the people that survived the market crash came out being really frugal, but they were unemployed, they had no money to spend, so they had to live life in frugal form. In the year 2000 and also 2007, when people lost their house, people were careful about buying houses, people were careful about taking mortgage, people were careful about opening businesses, so people left frugal. But in this 2021, we are leaving COVID-19 with more money in our pocket. We are getting smarter with our money. We're spending on things that we need to spend. We're not buying out every houses that we see. We're not buying everything we see. So we're being a bit smarter. So when we come out of this lockdown, we're actually having more money, and with the government support, we're going to get jobs. So I think the government is actually being smart globally, not just US, Europe, Japan, China. Everybody's working hand in hand, trying to get unemployment rate down in individual countries. So I'm less worried about the market crash, but I believe there's still bubbles in several sectors that should be in, like the EV sectors or the green sectors or some spec sectors, which I mentioned earlier. Those are in the bubble, but other companies with hypergrowth and the freelance economy and the semiconductor economy, the Teslas, the Apples, those are still in a good position. So those will less likely be crashed. So we need to assess them individually, not as a global holistic market on its own. I think the high speculative stock and new spec stocks, which are superly overvalued, those will get crushed. Okay, no issues. I'm not going to call out any names, but those companies that have came out in reverse merger, they came out declaring they're going to produce so many cars, declaring they're going to produce so many power charging station or blinking station or deployment. Those companies who are promising big numbers that's coming up in the next 5-10 years, those companies I believe will get crushed. That's why I've been saying since December and November and January that don't hold any more spec stocks, don't hold any more speculative stocks. Try to let them go, take profit, and move on to more of your hypergrowth and growth stocks. So I believe in still hypergrowth stocks like the likes, I will call out proudly, like the likes of CrowdStrike, Twilio, Fastly, Fiverr, Upwork, those companies who are actually breaking even, making money, Shopify, who are actually making money already. And if they do their forecast for Q1, Q2, Q3, Q4, and next year, if they do well, their revenue growth, they will be making money, and those companies will sustain. Those companies will grow. So that's my point of view. SPAC stocks will get crushed, but hypergrowth stocks will grow into growth stocks and will sustain for the future run. So this is me, and this is my view. I want you to leave a comment below so you can share me your point of view as well and what you think about it. So thank you very much. Have a good day. I hope you enjoyed. You can join me on the Discord channel, which is free, and you can also join me on Patreon, which I share more detailed information or behind the scenes. And other than that, you have a good day, and I hope to see you soon again. Bye.
I hope you enjoyed that video. Please like this video and subscribe to the channel. Please press the bell button. Ding dong. Finally, watch the recent video up here.